Good morning, everyone. Welcome to our webinar, How to Handle Weather Risks and Force Outage Risks. This webinar will be hosted today by the Energy One Group, Ian and Patrick, which will present the webinar later. I will introduce them. My name is Stefan Quentin. I'm responsible for the sales at the Energy One Group. Maybe a very brief introduction of the Energy One Group. It's an Australian stock-listed company, for those who haven't met them yet, which are providing software and services to the energy industry and helping the clients with the green transition. Actually, at the moment, 50% of the energy in Australia is handled by the Energy One software and services. Content-wise, it will give you some information about what are weather risks and forced outage risks, but also the concept of handling these risks with certain products. And also they will present some specific product samples, which are quite common at the moment in Australia and widely used there, but which might also have an application in Europe. Very briefly now to Ian. Ian is Ian Tannenbrink from CQ Energy, a partner of CQ Energy. He will present the weather derivatives part. Patrick Berg is a consultant at Risk Solutions International, and he will be presenting the forced outage products. I would like now to hand over to Ian to start with the webinar. Thanks, Ian.
Nice. Thank you for the introduction, Stefan, and good morning, everyone. Thank you for joining this webinar. We hope you find it interesting. I'll just share my... Yes, first of all, yes, welcome to this weather and forced outage product education session. Starting off, we've got the usual disclaimer, which we'll just skip through. As Stefan said, CQ Energy are part of the Energy One Group now. We were acquired in April 2022. We have a joint venture broking relationship with Risk Solutions International, which we've had since 2008. And we've worked together in the power markets primarily, and RSI also provide a similar broking service in the non-energy sector. In terms of our role as brokers in the Australian energy markets, CQ and RSI basically work with their clients to help them structure transactions, take them to market, and find the right counterparty at the right price to be able to transfer that risk to third parties. In terms of the Australian context and why there's been such a large uptake of weather and forced outage products down here, the Australian power market is an energy-only market. It doesn't have any capacity payments as such. And as a result, you have a market cap price of 15,500 a megawatt hour and a floor price of -1,000 a megawatt hour. And it's quite typical in this market, certainly during our summer period, to have extreme temperatures and significant volatility. And so we do see prices get to this sort of level, the 15,500, which is why people tend to look to buy these types of products to manage extreme weather events or manage the risk of losing generation capacity on the wrong day. And what I would say, whilst all power and gas markets globally are elevated at the moment, the Australian power market has traditionally been one of the most volatile global commodity markets historically, and that's a function of the price cap in this market. In terms of the European context, we understand, the large utilities in Europe have traditionally purchased weather products. Their focus has been on managing warm winter risk generally, and the risk of revenue impacts from warm winters. But due to recent events, buyers have been looking at buying cold winter protection and cold winter protection to manage gas price risk as part of that. Products to manage lack of sunshine and wind related to wind and solar farms have also been purchased in various European markets as well, which is also another product that we'll talk about. And forced outage products, both for gross pool and net pool capacity markets, are now starting to attract interest in Europe as well. And there are a number of transactions we understand that have been placed in Italy as part of that, which Patrick can touch on. Weather products, what are they in concept? They're products to manage weather risks were developed by Enron in the 1990s. They're applicable across any industry or commodity where revenue or price outcomes can be influenced by weather. The structures basically have to include some form of weather event, which must occur to trigger some form of payment. That weather event typically is something that's not around the mean. It's something more on the extreme side, but there are products in particular in Europe that have been done around average temperature type outcomes. And the payments can take the form of a fixed payment, so a known payment upfront when that weather event occurs, or as a function of a commodity price outcome. The structures themselves typically have daily and term limits. So whilst they're a competing financial product to other typical market instruments, because they do have a cap on how much they can pay out on a day or over the term, they tend to trade at a bit of a discount to other financial instruments in various markets. The market that has the greatest demand is obviously the energy sector. There's a lot of interest in products that manage electricity price risk and gas price risk, and there's been a significant uptake in solar, wind and precipitation structures in recent years as well. The structures themselves, they can take the form of puts, calls, collars, swaps and options, as in other financial markets. They're just a different style of instrument which includes some form of weather trigger. In terms of the limits that I mentioned, the term limits themselves, typically we see down here, people are looking for sort of term limits for products that would cover our summer period to have limits of around $10 to $15 million. We have placed some as high as $30 million. And certainly there have been, transactions globally where the amount of limit at risk from the sell side is up to $100 million. The structures themselves, they're all bespoke and they're structured around the risk profile the client is trying to manage. So they're not, there's not sort of a vanilla style product. Typically, when we sit down with clients, they have a particular risk that keeps them awake at night that's related to a weather outcome, and we build a structure around that risk and take it to market. It's not just the energy sector that has exposure to weather events, whilst they do have the greatest uptake. In addition to the normal utilities, the retailers, the generators, wind farms, solar farms, and hydro generators. The next biggest sector would be agriculture. There is a lot of agriculture risk that gets transferred globally related to frost, cold events, heat events, flooding, and the like. And separate to that, there is probably construction would probably be the next area where there is significant interest, and that's mainly related to delays in construction due to rain events. Who sells these products? The sellers of these products are typically large reinsurance companies or private equity funds where they're looking to diversify away from their core business. If there's events in the weather markets, for example, if you have a big weather event, it's typically non-correlated with earthquakes or hurricanes that may be forming parts of their other businesses if they're reinsurance companies, or if they're a private equity fund that has exposure in the equity markets, then they're non-correlated. So it's a way of diversifying risk. There is around 12 to 15 active sellers of weather-related structures globally. Most are based in the US and Europe. Some are based in Bermuda. And from a credit perspective, typically they are all S&P A-rated or better, because most of these products, the buyer is actually paying a premium. And so from a credit perspective, the credit needs to be strong, especially with the limits that are out there on offer. And what we do find with some counterparties where they may not have a strong credit, they typically use a fronting service where they may use a bank or someone like that, where they will cash collateralize and then provide some sort of bank guarantee or parental guarantee from a strongly rated parent. The structures themselves can be closed in either derivative or insurance form. Certainly in Australia, most transactions down here are closed in derivative form. That's simply because the markets down here, as they are globally, are settled through ISDA-based arrangements. So entities and middle offices are familiar with that type of documentation, and insurance contracts can come with additional costs such as stamp duty. And also with insurance contracts, whilst they typically require some proof of loss, what has developed over time is that the insurance contract or the insurance form basically has some sort of agreed parametric settlement clause, so you do avoid those proof of loss issues that are required. So the settlement mechanism between the two forms is very similar, but it's typically the on-costs associated with the insurance paper that makes people go down the derivative path. And as I said, people are familiar with that type of documentation. So what's the essential ingredients of weather hedging? Well, the weather data is the most important aspect. You typically need a long amount of history for a structure to be priced up, and typically you need some independent form of weather station. So in the UK, I think it's the Met that manages the weather stations there. In Australia, it's the Bureau of Meteorology. Typically, people will use one of their weather stations as the basis for determining or calculating what the weather settlement will be. So in the case of Australia, it's typically extreme daily temperature. So the seller of these products would like to see generally more than 10 years of historical independent data from a government-owned weather station, so they can model that with some certainty. And that data obviously needs to be available going forward, so the product can be settled. Once you have that independent weather data source, from there you need to determine what is the weather parameter that you're trying to manage, what is the particular strike, at what point do you find that you are being exposed or you're losing revenue. That then becomes the strike or the trigger point at which, once the weather event on a day or over a period, say a quarter, once that ends up being above that particular weather strike, then the structure is on risk and it can potentially pay out. As part of that, you then form your weather index, which is the third circle down the bottom, to work out exactly what the settlement value will be for a particular event. And then if there's a commodity price component as well, that will be obviously forming part of the structure, and that then forms the overall compensation mechanism. So in its simplest form, it could be on an extreme day above 40 degrees C in, say, Melbourne. If you have a day that's 41, the weather element has been met, the product is on risk. And then if you have a commodity price component and power prices are above that price on a day, then you get paid basically a fixed notional by the amount of the spot price exposure above your price strike. Looking at some sort of winter and summer examples, as I said earlier, what you tend to find is with natural gas distributors and retailers, they tend to be more concerned about warm winters. Warm winters means less sales, which has a bottom line revenue impact. So in Europe, that's typically, as I said, been the product that's had the greatest demand. Or in the case of cold winter, if it may be a case that you've underhedged and you may need to go to the market and potentially buy more spot gas or more contractual gas, and that could be well above the cost of where you've sold to customers, and that could incur financial losses as well. So hedging against warm winters and cold winters has typically been the European focus from our feedback, and certainly in Australia, it's been a focus on summer, where it's either extreme demand events which impact the revenue for retailers, or it's effectively mild summers that impact the revenue for generators, in that they may be underhedged, they've got merchant exposure, spot prices are low, and it's well below internal budgets and revenue expectations. In addition to that, there's also the ability to combine volumetric risk and price risk. So there's the 4 quadrants, or quantos as they're known. So effectively, it's a combination of the different things we talked about. It could be, you know, you're exposed to high price and cold winter risk. You're exposed to low price or warm winter risk. And they're typically the 2 red quadrants are the ones that people are trying to manage. People may buy or look to transfer the risk of one of those quadrants, or they may look to transfer the risk of both of those quadrants. Separate to that, there are periods where the buyers may actually get a benefit if there's high prices and warm weather, and low prices and cold weather. So at times there's been transactions where they may buy the 2 red quadrants, but they may, as part of that transaction, look to sell one of the green or both the green quadrants to actually reduce the price of the overall product, because the seller may potentially get some upside if the 2 outcomes in the green quadrants occur. So being bespoke type structures, all these types of options are possible. To give you a few examples, which are fairly generic and fairly vanilla, and you know, there are much more sophisticated versions of these, but just to step you through a number. The first one is a fixed tick heating degree day structure. Heating degree days, if you're not familiar, and cooling degree days are effectively a common measure of heating and cooling requirements for buildings. The strike for a heating degree day is 18 degrees C or 65 degrees Fahrenheit. And effectively on a day, if you have, say, a 20 degrees C outcome as compared to the 18-degree strike, it's 2 HDDs. And over the risk period, you add all your HDDs up, and that becomes the trigger for any payments that may or may not occur. So in this particular example here, the buyer was actually concerned about the risk of a cold winter, i.e. a lack of warm weather, and that cold winter may actually cause them to have to go and procure more gas for their retail business. So the reference weather station was Moorabbin Airport in Victoria. The structure, as I said, was heating degree day with an 18C average temperature strike across a day. It's the average of the maximum and the minimum. It was across our winter period. The buyer was purchasing a put option, and the strike was based on the cumulative sum of the HDDs over the risk period. This particular structure had a trigger price at 532 or less than 532. And so you can see that if the HDD outcomes were below that strike, then the payments actually increase on a linear basis as the winter became colder, or it became colder and there was less heating degree days. So at 525 HDDs, the retailer probably needed around 50,000 per HDD to manage their revenue risk. But once you got down to the more extremes of less than 505, then it was more like 150,000 per HDD they required, and the contract had a limit of $5 million. So if you had an extremely cold winter, potentially this contract could limit out, or it could not pay out at all, but there would be a premium associated with this that the buyer would have had to have paid to transfer that risk. And obviously the sellers would do their analysis on the risk of that happening historically, and also based on weather forecasts over that particular risk period. A little bit similar to what I talked about before with the 40 degrees C structure in Victoria. This is one from New South Wales. This is a fairly vanilla, typical type structure that gets closed in Australia. If there's one that sort of is more vanilla than others, it's this type of structure. So this is a contingent price cap. Bankstown is the weather station in New South Wales. It's triggered on a day when the daily Tmax is above 39 degrees C. It's over our summer period. It's for a 50 megawatt notional. And we have a 5-minute market in Australia in the power markets. So the settlements are based on prices over that 5-minute period. And the price strike is $300 a megawatt hour. So to give you a little bit of context around all of that, there are swap contracts in the Australian power markets, and there's capacity contracts. And the capacity contracts have a strike of $300 a megawatt hour, It's a legacy contract. It's been linked to effectively the cost of diesel or fuel for peaking generation. And so what people look to do to manage the extreme events, they either buy the $300 cap, which is the firm market traded capacity instrument, or they buy weather derivatives where they're still getting price protection above $300 a megawatt hour, but these products tend to be cheaper than the standard $300 firm cap, simply because they've got a weather trigger. So there's some basis risk. And they've also got the limits that I spoke about earlier. They've got a daily limit and they've got a term limit. So in this case here, the product would be triggered when a day is above 39. There's a 50 megawatt notional that they've purchased. They get paid for each 5-minute price when prices are above 300. They have a daily limit of 2.5 million, a 7.5 million term limit. And I've just given you an example non-binding indication there. And just to give you an example, this particular product was around 64% of the cost as compared to buying the standard market $300 cap. Even though the $300 cap would pay out for any period across the quarter, generally people only expect volatility to occur on days when you're getting above, temperature strikes of the 39, for example, that we've got in this structure here. So you can see there's a 36% discount, which is why it's attractive to buyers as a form of option and a cheaper way to hedge. And as part of this, sometimes we find that some of the sellers do require the sale of firm caps back to them to try and help manage part of their risk, but that's not the case for all sellers. This next structure is a precipitation structure. This is based on a basket of weather stations. There's 6 weather stations in total. Once again, the buyer, this may be applicable for, say, a hydro station that's worried about a lack of rainfall and a lack of fuel. So it would be a put on precipitation. So this particular structure sort of covers all of the catchment areas that they need to get their water from, and each catchment area, based on its particular size and its importance to their particular business, has a weighting or a correlation factor. So you can see that there's 6 weather stations. They each have a correlation factor, which actually determines their weather index. And you can see down the bottom of this slide the settlement formula, which takes those correlation factors by the various rainfall measurements at those weather stations on a millimetre basis across a day, and then comes up and determines over the risk period what is the total amount of rainfall that's occurred across this portfolio or this basket of weather stations. And so you can see here that the put strikes at 567 millimetres. If the amount of rainfall fell over that risk period that fell was below that, then for each millimetre below that put strike, they would get paid $100,000 down to a put exit of 467 millimetres or a maximum of $10 million, which is where the product limits out. And this is something that's been purchased by hydro generators down here over the years. Separate to that, we have had people that buy an opposite product, people that may be worried about too much rainfall, and that could be a coal-fired generator, for example, somebody who's worried about wet coal and not having enough fuel because they can't burn that coal. So we can see the opposite side of that as well. And sometimes we've seen structures where people will look to actually purchase the structure as a zero cost collar, where it will have a put component, a call component. There will be an equal probability of the put and call paying out. So as a result, the product doesn't actually have a premium as such, but the buyer of the put is happy to do that because they don't need to pay a premium. But they do understand that if there's a high amount of rainfall, then they may need to pay some of the upside that they get from that away to the seller of the product. And the next two I'll just touch on before I hand over to Patrick is a sort of a standard wind and then a solar firming structure as well. Typically with these products for wind are settled based on hourly wind speed. The hourly wind speed data typically is from the on-site turbines. It's picked up through the nacelle on each turbine. It can be done through readings from weather stations. Typically, though, weather stations don't sit on the same site as the wind farm itself. So people, because of the basis risk, people tend to like the wind speed readings off their own turbines. That particular wind speed is put through the power curve for each particular turbine, multiplied by the number of turbines to simulate what should have been the production from that wind farm based on the amount of wind that was blowing at that particular point in time. That then determines the simulated generation as such. And from that, there is an hourly wind strike in this example of 150 megawatt hours. So if the simulated wind generation based on the wind data was below that 150 megawatt hour strike, once again, the buyer's buying a put on a lack of wind, then the wind farm owner hasn't received the amount of revenue they would have expected over that period. And so for each megawatt hour that didn't turn up, they get paid $100 a megawatt hour to compensate them. And that $100 is just a number that I've come up with, but it could be a function of what power prices are in the market at a point in time, or it could be a combination of power and green certificates or some sort of environmental certificate that they don't get paid for. And once again, this product's got a daily limit and it's got a term limit, and there would be a premium associated with that for transferring that volume or put risk to the seller of the product. And in a similar vein, in terms of solar, people with solar farms have looked to buy puts on lack of solar or lack of irradiance. Typically, the weather data in relation to solar farms has been irradiance, and the irradiance has either come from a weather station if it's nearby. If it's not, typically it's through gridded satellite data, and there's a couple of versions of that exist. There's ERA 5 and there's Mirror 2. Mirror 2 is NASA data, but it's effectively satellite data that captures the amount of irradiance at a gridded point, which is typically over the top of the solar farm. You then put that irradiance through the power curve or the plant capacity, multiplied by its performance ratio or its efficiency. And once again, that comes up with what the solar farm was producing at a particular point in time. Once again, you would have a production strike. If the amount of solar on a day was below that production strike and you're not getting the revenue that you expected, you would get paid some form of compensation for that. That compensation, once again, would be at a number that you determine, and it would be capped by a daily limit and a term limit as well. So that's the quick snapshot on the weather product side. Lots of variations to this, and much more sophisticated and complicated structures, but hopefully it gives you a flavour. And I'll hand over to Patrick now to talk about forced outage.
Thanks, Ian, and thanks to all for joining. Ian's going to help me step through the slides as well, and any issues with my sound, Ian, please let me know. We can move on, and similarly, this will be a quick tour and focusing on the Australian context as well, but a lot of parallels to draw with other markets. We'll go to the next slide then. So the product has a long history in Australia and elsewhere, going back to 1999, and our colleague Roger Curry, who joins us, was instrumental in bringing that product to Australia in the early days of our unified market. I think another occasion we might have to talk about some other firsts as well for our market. Sticking with that, forced outage, currently they're a major theme at present and a large driver of volatility. In June this year, we had simultaneous offline units of nearly 25% of our 23 gigawatts of coal capacity, and that was over several days. There was also curtailment for gas because of economic reasons or mechanical reasons as well. Apart from international factors, of course, we think outages illustrate the presence of risk all year round, and currently also see elevated prices across the board, delays and overruns due to planned maintenance and catching up from COVID-19 impacts with scarcity of personnel and equipment. There's instances of maintenance extensions and startup failures, and even now fresh outages, particularly in Queensland, one of our states, in early this month as well. We can move on, Ian. So the cover can be used in energy or capacity markets. Here we mainly focus on our energy market, but elsewhere it is offered, and in each case the payout's tailored to the particular market. As Ian mentioned, in the same with weather products, it can be offered in derivative or insurance form, where a highly rated risk carrier provides forced outage cover in return for an upfront payment or premium. Coal and gas generation historically have been the main applications, and also pumped hydro. More recently, applications in wind and solar, and we think looking ahead, battery. There's a spotlight here on coal capacity and their retirement, and so counterparties of the insurers and other capital providers who offer these products also looking to new opportunities as a result. Unlike with weather, we're generally relying on proprietary data here, so buyers in the main have been limited to the owners and operators of the plant, and they might only have the necessary data for underwriting and settlements. As we'll see, that's changing when it comes to renewables, with more publicly available information, and we understand it can be different in other jurisdictions as well, depending on just what's made available. The typical scenario we find is a short, sharp outage at the wrong time, but the product can also be used to manage longer term impacts as well. And more recently with renewables, it's possible to cover outages and low wind or solar resource, i.e. the weather risk, which is particularly useful for off-takers or retailers to manage variability. The covered events, as we call them, divide into planned outages and unplanned deratings or partial outages. The definitions are in turn based on corresponding definitions from the International Electrical and Electronics Engineering Institute. Classes 0 to 3 for outages and class 1 to 3 for deratings. We've got some more information on those to follow as well. And we've got a state transition matrix there. But in short, the IEEE provide the standard taxonomy for classifying and rating and reporting on power stations. That transition matrix shows transition from one state to the next, for instance, planned outage to unplanned outage. These definitions centre on timing and control or lack of control, with mechanical breakdown being the most common cause, but not the only cause. So there's no attempt made to define each and every issue that might possibly go wrong. And the class 1 outage, for instance, is an immediate trip. The difference with outages and deratings is the class 0 outage, which is a startup failure and only for outages. So moving on here. With parallels to the structures Ian went through, a settlement or payout is determined by a notional quantity and the spot price for each applicable trading interval, usually from the start of the event rather than being deferred. There can be overlap with other cover or insurance such as business interruption, but again, it's usually right from the start of the event that cover's sought. And there's various considerations for structuring a product. Running through some of those main ones is obviously the assets, which can be a portfolio to a single asset, across a single region or multiple regions, depending on the client's fleet. Terms are typically 1 to 2 years, or particular quarters, such as Q1, the all-important one Ian talked about for Australia, or other periods such as relating to planned outages, where you might be covering the other unit or units that aren't on planned outage, but there could be overlapping events. On those events, cover might be for forced outages only, or for forced outages and deratings, those partial outages. For the notional quantity, we see generally equal to all or part of the station or unit's capacity, and generally from 100 megawatts up to several hundred megawatts, depending on the station or stations. You can incorporate deductibles or retention. So with megawatts, it could be the first unit equivalent, so that you're covering the second unit or other units for overlapping events, or $1 deductible if you're managing working losses or just premium levels. Again, what Ian was talking about with the standard products that trade through our exchange, previously strikes were set at $300 per megawatt hour, which was important for benchmarking and also generally seen as our threshold for capacity pricing. But now we see that increasing to $500 and $1,000 in line with other traded products, and as a function of that heightened volatility and elevated prices. There are time limits to events, so this can be based on single events or overlapping events. 7 to 14 days is common, but much longer is also possible. Again, emphasising those short, sharp events in the main and overlap with other cover that might be available through business interruption insurance. And then payout limits are typically between $10 and $20 million, depending on the size of the program. But again, pushing up in the current climate. And there, just for reference, we've got more information on those IEEE definitions and the relevant timeframes, and emphasising their flexibility and that they cover events without actually naming exactly what must go wrong at any particular time. And then that's me finished there. I'll hand back to you and Stefan.
Thank you, Patrick. Thank you, Ian, for the interesting walkthrough through the weather, handling weather risks and also forced outage risks. So what I take away from this, it seems like these are very tailor-made, very individual solutions. You show some examples, Ian, on the Australian market, but this can be also adapted to the European market. Is this correct?
Yeah, absolutely, Stefan. As long as you've got weather data, that's all you need to structure the product. As I said, it can be a fixed payment, or you can link it to a commodity price. So it doesn't matter where you are, as long as there's a weather event that's at risk and you can get the weather data to measure that weather event. And if you want to link it to a power or gas price or whatever it might be, type outcome in that region, yes, everything can be structured. It's all down to the data.
Okay, just a question regarding the data, if I can pick this up. The wind data, which might be very specific on solar wind farms, is there anything typically you would use to retrieve the wind data for these risk solutions?
If you're looking at wind farms, typically the asset owner will have access to the wind data through the nacelles on the top of the turbines. We have had structures where it's not the asset owner that's looking to actually purchase or transfer the risk of that particular outcome. There might be someone that's got some offtake associated with it, or someone that's worried about the amount of wind in a region per se. And so if that data is not available from the wind farm operator, then it can generally be obtained typically, because as I said, the weather stations, the government ones typically aren't on the site. So in that case, we would normally use satellite gridded data to be able to determine what those wind speeds would be at that particular site. And there's a few sources of that, but generally they've been extremely accurate, and most buyers have been very happy with the basis risk with that data.
Okay, thanks, Ian. Just one more question regarding the commercial part of this. As we have in Europe different providers of settlement prices, of indexed prices, is there any limitation on this, or is there any regular limitation on the settlement prices?
Yeah, look, if you typically, if you are linking the payments to a commodity price, that the sellers do need to have some transparency around what that commodity price looks like over the risk period. So certainly down here in the Australian markets, our power markets tend to trade forward for about 3 years. So if you're going to buy a weather product that has its payments linked to commodity price outcomes, you would only probably be able to buy something up to a 3-year term, because after that, the sellers are obviously not active in these markets all the time, so they don't know what that commodity price risk may look like without any independence. So that's a bit of a restriction, but in some markets like the US, they trade forward for 10 years. So there's 10-year type transactions that happen there. If it's just a fixed payment, it's not linked to a commodity price, then yes, transactions have been done 10, 15 years in some cases. In that case, it's just a pure weather deal when somebody takes a view on the weather risk.
Okay, and then a more generic question, because the topic of climate change is quite present at the moment. Do you see any trends on the pricing, especially on the mid or long-term side, regarding these extreme weather situations occurring?
Yeah, look, that's a good question. The short answer is yes. The analysis that goes into determining what's happened historically in terms of what we call working losses or payouts does take into account any trends in terms of pricing the product going forward. So, if you've got, say, 10 years of history, but the last 5 years show a distinct warming trend in that the average temperature over those years is much higher than the average over the 10, or there's a steep, shift upwards over the last 3 years, then the sellers will price that into the structure, and that will be taken into account, because obviously there's a high probability that event could occur again. And we have seen that in a number of structures down here where, the actual buyers just take a straight average, don't take that trend into account. And there is a disconnect between what the expectation is between what they should be paying and what the seller is looking to sell at. But typically, if those trends exist, that they exist for a reason, and they need to be considered.
Okay, thank you, Ian. And then Patrick, maybe a question to you regarding the forced outages. Are there any exclusions what can't be handled by these risk derivatives or insurances regarding the outages?
Thanks, Stefan. There are. They are limited though, and they're generally part and parcel of the risk being sought to be covered. Planned outages obviously not covered. That's something the station has control of, or is assumed to. There's obviously exclusions for fuel quality, fuel availability. Again, that's not something the risk takers can control, but assumed to be controlled by the plant operator. There is interesting overlap there, as Ian touched on, with coal production and weather affecting coal stockpiles. So again, sometimes it's a case of meshing other products that account for these exceptions. And then I guess overall, the product doesn't cover each and everything for an endless time as well. So those time limits are crucial as well, depending on what sort of event you're trying to cover. So we work through those with clients, but they are limited and just go to the risk allocation in the main between the parties and what the operator should have control over.
Okay, thanks, Patrick. And then one more question regarding the commercial part. How would you typically benchmark the pricing for these kind of products?
So it's similar again to the weather side. There's reliance on our ASX, our stock exchange, for that forward price transparency. That's the reason why terms are generally limited to 1 to 2 years, where the curve is more liquid. Clients and counterparties alike are using that to price and assess what's being put forward. They're generally looking for a discount to those standard capacity products. But we also see those $300 triggered capacity products being very expensive, and the market looking to higher strikes. That's also, for those reasons, feeding into the strikes that we see for forced outages as well, because of elevated prices. These are products designed to have dual triggers, not just the outage, but price as well. So they do need to trigger when there is heightened volatility, and now that's prices above 300, above 500, above 1,000. So it all goes to what's available for benchmarking purposes.
Yeah, and probably on the weather side, typically the discount to the firm product, or the $300 cap I talked about, typically the discount needs to be 40% or more, because the buyer is taking on some basis risk by having a temperature trigger in there, and they've obviously got capped daily and term limits. So the product becomes a little riskier from that perspective. But the offset of that is the much cheaper cost of the product. So anything that's typically 40% below market or more is where we get the interest levels.
Okay, thank you, Ian. Thank you, Patrick. We got now the first questions from the audience. First question is do you use a long-term weather forecasting model? And what data source you would use for this? To evaluate, I think this is the question.
Yeah. I think typically, because of the products in the power markets, because they're sort of 1 to 2 years forward, as we talked about, it's really the near-term forecasts that are provided by the government weather agencies that are typically used by the sellers to form a view as to what the market might look like over that period. So, for example, we've just had a La Nina in Australia, and we're going into another La Nina over our summer. So people are expecting cooler temperatures and a lot of rainfall. And so that is being factored into the pricing and the demand from clients as well, in terms of what they're trying to buy based on those short-term weather forecasts. But I'm sure the sellers would be looking at, third parties as well to give them the same sort of view. And then certainly with longer term transactions that may be just based on fixed prices that don't have a commodity price component, the sellers themselves would be taking a view or multiple views as to what the long range forecast may look like. Certainly in our role as brokers, we don't get involved in that side of it, because it's the sellers that are really determining the risk and pricing that risk.
Okay, thanks, Ian. Then another question. This is going to Patrick. The question is, what is the difference the insurances or derivatives you provide versus a business interruption insurance, a typical business interruption insurance?
Yes, so thanks for that. I think in short, when it comes to the differences, the forced outage product has a direct relationship with prices at the time of the outage and can kick in right at the start of the outage, whereas serving a different purpose but working together, business interruption can kick in at a later, or typically kicks in at a later date, can be up to 90 days. And by then, a lot of the volatility may have been missed, and the link to those prices again can be muted. I guess putting in a good word for the product we deal in, and not focusing too much on the alternatives, but there's obviously capital constraints too with business interruption. A lot of insurers have coal and carbon policies that over time are preventing them from offering insurance to existing projects or newer projects. So capacity is an issue there as well. But in the forced outage space, there's certainly a strong acceptance that there's a transition going on as well, and so that the capacity is continued to be offered.
Okay, thanks, Patrick. One more question here, I think, and then we should also close the session. The sellers of the products, of the insurances and derivatives, do they have experiences in the European market?
Yes, they certainly all do. As I said earlier, a lot of the larger utilities have been buying weather products probably for 10 to 15 years. So all of the sellers we deal with, whether they be weather only or weather and commodity, are very active in all markets globally, where there is typically some commodity price transparency. So the European market has typically been one where there's been large limits that have been requested. And as I said, warm winter risk has typically been the product of demand for the retailers.
Okay. Yeah, then I would thank you, Ian, for your answer. Patrick also. And then I would now, as there are no open questions, close the session. We will, as said, provide the video and the slides as well as the questions. Yes, and this is also a question. The recording will be also made available afterwards. This will be sent all to the attendees. And if you have any questions or inquiries, please feel free to reach out via the email address, which you see here, energyrisks.info@energy1.com. Then Patrick and Ian will take care of this and answer your question. So then I'm just having to thank you, Patrick, Ian, again, for making this webinar. Thanks for your time. Thanks for the attendees to participate, and have a great Thursday. Bye-bye.
Thank you.
Oh.